Hi, I'm Fook with Alpha B Group, and today we're going to talk about NSOs. If you worked at a startup that gave you some NSOs, then definitely watch this video because I want to go through the different situation and different tax situations that you might face. Also, because you have colleagues with the same situation, you should share this video with them. So to start, I'm going to go over the first scenario. Let me move my fist. Okay, so let's just say your strike price is $3 and your first grant, when you're first granted the shares, is 115.20, and a year later 115.21. That's when you get your first vest. So let's just assume you exercise right when it vests, and you exercise at $5, and then 2 years later you're going to you sold the shares for $20. Nice profit, but you're going to have to calculate taxes. So in 2021, when you first exercised, you're going to pay ordinary income tax on the delta between the $3 to the $5. Now, what sucks with NSOs is that you haven't even received the cash for this yet because you haven't sold it, but you still have to pay taxes on your wage income because it's going to show on your W-2 for NSOs if you exercise and hold. So if there is a delta between here and here, between your strike price and your exercise price, that's going to be taxable income. Now, for capital gains, this part is going to be capital gains. So the fair market value at what you exercise is going to be your new basis. So then when you sell it at $20, this range right here, $5 to $20, that's going to be capital gains income. So in this case, it's going to be long-term capital gains income. Let's use another example. Let's just say that same situation, $3 strike price, same dates, vest dates, so on 15, but maybe on this date, you didn't feel like exercising. Maybe you felt like the company wasn't going to do too well or it wasn't going to grow. However, a year later, in year 2022, the stock doubles. So now you're like, ooh, I should exercise. So what you do, you exercise on this date. This is what it's going to look like on your taxes if you exercise on that date. Is that from $3 to $10. Now that's ordinary income. Again, you haven't received the cash for it. This is phantom income, but you still have to pay taxes on it. And then let's just say you decide to sell a year later. So because you pay taxes up to the $10, this is your new cost basis. And from $10 to $20, that's subject to capital gains tax. Before I move on, please make sure that you give this video a like. It lets me know I'm doing a good job and it motivates me to actually make more videos. So if we get this to 20 likes, that'd be super awesome. Moving on to the next scenario, let's say you exercise and sold same day. So you exercise and you just sold it right away. So what this looks like is that the whole thing is ordinary income. The good news is that at least you got the cash to pay the taxes on it. The bad news is that it's all ordinary income. You're taxed at the highest rate possible. Actually, just kind of going back to the first scenario here. Let's say in this situation here, when you exercise the shares at $10 when the strike price is $3, because it's considered ordinary income, you have to pay taxes on it. Now, some companies may even ask you to write them a check to cover the taxes. So be aware of that you might still have to write a check to cover taxes. Another thing to be aware of is that the amount that they tell you to pay in taxes might not even be enough to cover your actual tax bracket. So be very careful when it comes to NSOs, is that they are going to ask you to pay taxes. So you're going to pay it with either the company's going to withhold it from you somehow, or they're going to ask you to write a check. So going back, let's see, we did this. Okay, now let's just say in this example where you have the strike price of $3 and let's just say you exercise at $20 about a year later in year 2022 after your vest date. So what happens if the stock doesn't go anywhere? Let's just say that you exercised here, stock went down to $18, but now 2 years later after you exercise, it is worth the same value as what you exercised them. So if you were to sell it here, what's going to happen is that you already paid ordinary income tax in year 2023 right here. And the problem is that because it's already reported as income, you have to pay taxes on that. But now that the stock hasn't gone anywhere in 2 years, there is no capital gains. It's just stayed the same price. So you got no benefit by holding it for 2 years if the stock remains the same. However, if say you sold it in here when it took a loss of $18, from here to here, that it's $18. So the $2 loss, we could actually report that as a $2 loss on your tax return. So hopefully, if you do decide to exercise and hold, you're doing it hoping for the stock to go up. However, if the stock doesn't go up and it stays stagnant, then you're not getting any long-term capital gains benefit. You just ended up paying ordinary income tax from this point to this point. And that's NSOs and the tax behind it. Our firm, we truly believe in tax planning, that it's the best way to really know where you stand tax-wise. So definitely, if you did exercise some NSOs, do some tax planning, know where you stand, and know how much taxes you might owe at the end of the year. Be proactive and ask questions, because that's how you save taxes. That's it for my video. Please give it a like. If you know anyone that might benefit from this video, give it a share. Also, I think that's it. I'm off to my next video.